Welcome back to Candlestick Signals for today's market. August 1st, 2025. Brace yourselves for a roller coaster ride. As we dive into the candlestick signals that are shaping the financial landscape, today's session has been nothing short of dramatic, with sharp declines across major indices and a flurry of bearish patterns emerging. But amidst the chaos, there might just be a glimmer of hope for the bulls. Let's break it down. The U.S. stock markets experienced a significant downturn today, with the Dow Jones Industrial Average plummeting more than 500 points. This wasn't just a minor hiccup. The S&P 500 fell 1.35%, while the tech-heavy Nasdaq Composite contracted by a whopping 1.7%. These losses come on the heels of a week-long downward spiral, fueled by escalating trade tensions and a disappointing July jobs report that has left investors on edge. Let's take a closer look at the candlestick structures that are telling the story of today's market movements. The S&P 500 displayed a significant reversal structure, with a Belt Hold Bearish candlestick forming on the daily chart. This bearish signal was further reinforced by a three black crows pattern on the 5-hour chart, painting a grim picture for the bulls. However, in a twist that exemplifies the day's volatility, a late-session bullish hammer emerged, hinting at potential indecision in the market. Moving over to the Nasdaq and Dow, we observed strong red candlestick streaks, including patterns reminiscent of the three black crows. These formations underscored the continued bearish sentiment that dominated throughout the day. The persistence of these bearish patterns across multiple indices suggests a broader market correction may be underway. Interestingly, the Nifty 50 told a slightly different story. A series of doji and small-bodied candles reflected market indecision, pointing to an upcoming breakout or further consolidation. This indecision in the Indian market could be a precursor to significant moves in the coming days, as traders await clearer directional cues. In the commodities space, gold reversed direction from support and looked poised to test resistance at 3,450. This movement suggests that buyers are tentatively re-entering the market after recent pullbacks, potentially seeking a safe haven amidst the equity market turbulence. Now, let's dive into the technical interpretation of these candlestick readings. Today's patterns signal mixed, but predominantly bearish momentum. The presence of three black crows and Belt Hold Bearish patterns increases the odds of a continued market correction, especially when paired with weak macro headlines and heavy trading volume. These formations are particularly concerning as they often precede further downside in the short term. However, it's not all doom and gloom. The bullish hammer patterns that emerged after sharp declines hint at the potential for short-term rebounds, provided buyers show strength at key levels. These patterns often indicate that sellers might be losing steam. A reversal could be on the horizon if confirmed by subsequent bullish price action. The doji and small-bodied candles we observed, particularly in the Nifty 50, signal ongoing indecision. In such scenarios, the next strong directional move could be sparked by fundamental surprises or technical breaks. Traders should keep a close eye on key support and resistance levels, as a break of either boundary is likely to trigger outsized volume-driven moves. It's worth noting that market momentum remains confined by crucial moving average clusters. Breaking these can indicate a sea change in trend dynamics, potentially setting the stage for the next major market move. Shifting our focus to sector and stock highlights, the technology sector faced considerable selling pressure today. Semiconductor and large-cap tech stocks bore the brunt of the decline as investors rotated out following a strong run. This sector, which had been a market leader in recent weeks, saw its momentum stall as concerns over valuations and the broader economic outlook took center stage. Industrials and cyclicals lagged under the weight of tariff news and recessionary fears. The announcement of new tariffs has reignited concerns about global trade tensions, putting pressure on companies with significant international exposure. This sector's performance today underscores the market's sensitivity to geopolitical developments and their potential impact on economic growth. In the consumer sector, sentiment remains above pivotal thresholds, but is weakening. Investors are closely watching upcoming jobs data for confirmation of the sector's health. The disappointing July jobs report showed the labor market adding just 73,000 jobs, well below expectations, has raised concerns about consumer spending power and overall economic resilience. Gold, as mentioned earlier, rebounded off major support, reflecting a defensive shift amid macroeconomic uncertainty. This movement in the precious metal market often serves as a barometer for investor risk appetite, with gold typically benefiting from periods of market turbulence. As we assess the short-term sentiment, it's clear that the market tone is cautious to defensive. Investors are focusing on risk management and selective positioning due to policy and macro uncertainty. The combination of trade tensions, disappointing economic data, and bearish technical signals has created a perfect storm of uncertainty, prompting many to adopt a more conservative stance. Looking at the technical outlook, signals point to a possible near-term market retracement and increased volatility. Close attention to key support and resistance levels is essential as they could dictate the market's direction for August. The S&P 500's current position relative to its 50-day and 200-day moving averages will be crucial in determining whether this pullback is a temporary setback or the beginning of a more significant correction. In conclusion, August 1st, 2025, saw decisive broad market declines and heightened volatility, driven by economic disappointment and renewed trade risks. Bearish candlestick patterns dominated, highlighting the market's vulnerability to further correction. The Dow Jones Industrial Average's 500-point drop, coupled with significant declines in the S&P 500 and Nasdaq Composite, paints a picture of widespread market weakness. Monitoring key support and resistance levels is now paramount, as breaks could produce high momentum moves in either direction. For the S&P 500, watch the 5,770 level as critical support, while 6,279 represents significant overhead resistance. The Nasdaq Composite's 20,000 level could prove to be a crucial battleground between bulls and bears in the coming sessions. Given the defensive sentiment and technical posture, disciplined trading and robust risk strategies remain critical as the market forges ahead through a historically fraught month. Investors should be prepared for potential further downside, while remaining alert to any signs of a reversal or stabilization. As we move forward, keep a close eye on upcoming economic data releases, particularly those related to employment and inflation. These figures could provide crucial insights into the health of the economy and potentially influence the Federal Reserve's monetary policy decisions. Remember, in times of market turbulence, staying informed and maintaining a balanced perspective is key. While today's candlestick signals paint a predominantly bearish picture, markets can be unpredictable and opportunities often arise in the midst of uncertainty. Stay tuned for our daily market updates as we navigate these choppy waters together. Thank you so much for watching. Hope this video helped you out. We will see you back here tomorrow. Before you go, please leave a comment, smash that like button, and subscribe to be notified when new content is available. The information presented in this report is intended solely for entertainment and informational purposes, and does not constitute financial, investment, or trading advice. All opinions, analysis, and statements expressed herein are personal views and are not recommendations to buy, sell, or hold any securities or assets. Market data and any related commentary are provided as is, and may not be accurate, complete, or up to date. Neither the author nor the publisher assumes any liability for financial losses, damages, or other consequences resulting from actions taken based on the information contained in this content. Please consult with a qualified financial advisor or conduct your own independent research before making any investment decisions. Investing in financial markets involves risk, including the potential loss of principal. This content is purely for entertainment purposes and should not be relied upon for any financial decisions.